Victor, remember, fibs, mid-bands, yellow one-to-ones. Those are your areas. Divergence is just a loss of momentum. Um, and on the large chart, it can be pretty bouncy. On the small chart, unless there's three of them, it's just noise. I hope that makes sense. Good morning, Steve. Great to have you guys here today. Andy V, Wayne, nice to see you back in the room, man. Been a while. Hope you're doing well. Miss Estefania, great to see you. Samuel, great to have you. Todd, Pete, Chris Novak, what a silly last name. Milton, great to have you. Steve Matthews. Good morning, guys. It is Wednesday, August 6th, and the only real news that's coming up on the radar is crude oil inventories. So if you are one of my crude oil traders at 10:30 a.m., they're going to release the barrels or the reserves. And the market has been known to spike, to jump, to change directions, to speed up, to become untradeable. And because you know about it, hey, Andy B, because now you know that at 10:30 a.m. things could go sideways in your crude oil market, you could, if you choose, make the decision not to trade. To sit on the sidelines for a minute, to wait for the reaction to settle down, and then look for your opportunities. This room is just a living proof example that repetition works, guys. And there's a way to get to where you want to be in this room, guys. There's a way to get to where you want to be as a day trader. And I feel compelled to say this morning, just based on some conversations that I've had recently. Guys, day trading puts you in a position when you do it well, when you have a plan, when you're following rules, when you're consistently winning, to absolutely change your life, to change it for the better, to give you opportunities that weren't there before. Day trading gives you the opportunity for a six-figure income, never leaving your house. For a seven-figure income, never leaving your house, guys. So with that being said, you may have to put a little work into it. I want you to think about what your career was. If you were a doctor, you went to school for 7 or 8 years to become that doctor. But doctors walk into this room and they want to be a day trader in 2 days, and they want all the answers in the first 17 hours of their journey. And guys, I'm telling you, this classroom is designed around the idea that you will have to put a little work in to get to where you want to be. But my promise to you is I'll give you the work to do. I'll show you what to study, and you won't have to spend 8 years to become a professional, right? You'll spend 8 years learning. You'll always be learning. But guys, you're going to be able to give yourself everything you need to be successful with the software within your first 30 days if you keep it simple, if you keep it focused. If you believe that sitting in my room is going to make you a great day trader, then I would say go watch videos of Tiger Woods and let's see if you can become a professional golfer next week. And that's kind of what I've been getting lately. So sorry, a little bit of a soapbox there. Do the work, guys. The work you put into this, it will be what you get out of this, without a doubt. And the work isn't too hard. You've got to learn 3 rules, and that's what we're going to do this morning. We're going to learn 3 rules that are a high probability trend trade that have been proven. It's repeatable. It's testable, and it's been proven that when you follow the rules for the high probability trend trade, you have the potential to win up to 70 to 80% of the time. A high probability trend trade is only 3 rules, guys. It is strong triggers, nothing in the way, and go define your entry. Each rule, when true, gives the advantages. We're going to go with the idea that a trade is momentum plus a clear path, and then go define your entry. These 3 rules happen on only 2 charts. There's a large chart. It's a slow chart. The first 2 rules are met on this chart. There's a small chart. It's an entry chart. It is where you're going to refine the big picture and find an entry. We use these 2 charts because there's forces that move the market, guys. And the large chart is a reflection of the forces that can create momentum, that can establish trends, that react at key areas. Your small chart is just fluctuation. It is a little bit of noise inside of the big picture. We rely on this noise for entries because it's a smaller, faster chart. It's a small crowd, guys. We're going to pinpoint where that little push is most likely to fail to give you the highest probability trend trade ever. So the goal for new users is I want you to learn how to identify momentum. And we're going to talk about it this morning. And if you have a question, I'd like you to raise your hand. I promise you we'll get you the lesson that you need. We're going to talk about how to identify a clear path. This is your core. When you understand momentum and path, it's like doors open, paths clear. Momentum and path are the driving forces to successful trades. Entry is going to change. It's going to change, as you grow, as you see more. But initially, in this room, we're going to talk about momentum, path, and entry on every chart. This is a high probability trade. Each indicator on every chart agrees with the rules for the trade. When you look at your charts and you notice one of your advantages is gone, you're going to say, okay, this is a medium probability scenario. I may need to manage a little more assertively. I might need to take profits a little faster. I might need to get break even just a little sooner than I normally would. If you look at your chart and you notice 2 to 3 are gone, then you're going to have to say to yourself, man, this is low probability. This may not be my trade. So we're going to go through the room and we're going to talk this morning about momentum, path, and entry. We're going to talk about it on NinjaTrader first. We'll discuss it on TradingView second, guys. But before we do anything with rules, let's talk about what we're looking at on the screen. Let's describe the indicators. Usually most people show up having already watched this video, but let me give you the video in case you're new. One of the great things about this website is it has everything that you could ever hope for. And this video right here goes through every indicator that you're going to use. It tells you exactly what it is and how you're going to use it. But I'm going to do the exact same thing in the room so that if you have a question, we can answer it, guys. You're going to see trigger lines on both of your charts. You're going to see small triggers, 2 solid lines, and you're going to see large triggers, 2 dashed lines. These triggers are going to work together in everything that you do. Small triggers are fast, large triggers are slow, guys. We're going to use them first to define the momentum for rule number 1. Once you have momentum, we're going to use the trigger lines anytime you reach an area to determine whether or not that area could be problematic. And then finally, we're going to use the large triggers to define entries. They're just moving averages, and they will define momentum, termination conditions, as well as entries. Also on both charts are areas. Areas are horizontal lines that run across your chart. They all have names. There's divergence highs. This is a magenta line. It's a clever way of saying hot pink. And this will print if there's a loss of momentum at a pivot. All the math to determine that is done in the background. You don't even have to compare MACD BBs or price swings. All you have to do is see that magenta line and understand the market lost some momentum. Down at a low, if you see that same loss of momentum, you'll see the cyan line. And the cyan line lets you know that there was a loss of momentum at the low pivot. You're going to see Fibonacci resistance, guys, and this is an accumulation of tens of thousands of calculations based on historical swings, different time frame swings, and all the calculations come together to give you a solid red line where the market may stop or reverse from an uptrend, and you'll see that solid blue line down at the bottom. If the market is trending down, this is a spot where the market may bounce, may reverse, may create a fight between those buyers and sellers. Yellow 1-to-1s are fibs that print in the moment. If the market's trending up, they may behave as resistance. If the market is trending down, they may behave as support. So we're going to use areas, both large and small, and we're going to use triggers on both the large and small charts. And we're going to use these tools to recognize 3 advantages to get you the pattern, the recipe for the highest probability trend trades you could take. It all starts with momentum, guys, and I'm going to tell you, we're going to learn these rules. I want you guys to post in the room. Post a picture, post a question. If you're looking at your charts and you don't understand what you see, show me. Tell me, hey, Mark, what's this line? What do these dots mean? What are those triggers telling me? I'll give you every answer that I have rattling around my noggin. Uh, Post in the room is the way to get to where you want to be the fastest, guys. Show me what you're thinking. Show me what you see. And then finally, keep it simple. You've got to learn the looks, and that's where the spreadsheet comes in, guys. So you have the ability to show me everything that you're doing. These are two charts, annotations that go back to momentum, terminations, and entry, telling me what you see. And when you've done it well, what you've done with your annotations is you've written a recipe for success, guys. You've literally identified and spoken to what it takes to get you into this trade. The second part of getting to where you want to be is, guys, take a million pictures. If you are on NinjaTrader, this spreadsheet, I'm going to drop this in the room. This is your Ninja Trade Tracking Sheet, Nexgen Trade Tracking Sheet, and there's also one for TradingView. So I'll drop both of the spreadsheets in the room right now. This particular sheet shows you 50 pictures of strong triggers so that you can really understand that idea of momentum. It shows you weak triggers so you know when that advantage is gone. It shows you what it means to have a clear path so you know when rule number 2 is met, and it shows you those termination conditions when the path isn't clear so you know when to sit on your hands. It also goes into entries. We've got the client trade section. This is going to go through the entry sequence and the high probability trend trade on that smaller, faster chart. About 500 pictures of Nexgen users using the software, embracing these patterns. If you are an adrenaline junkie and you want to trade the NASDAQ, there's some thoughts on it. Ideas on management. The top 4 here are from the plan that I'm going to give you to keep it very mechanical. Below it are ideas when you can hold for bigger moves, different ideas to change your management plan, patterns that repeat themselves. There's a place to build your plan, to take the pictures. Every time you take a trade that fits the rules, it's a great spot to put it. You can come back and burn that look into your mind. And then there's a trade tracking sheet. And this trade tracking sheet is on both of the spreadsheets that I just dropped in the room. This is a place for you to track your progress. And there's a picture, how to annotate for the best feedback, making sure that you tell me what you see so I can make sure that you see it correctly. Pasting into the spreadsheet, capture software. And what you're going to do is you're going to drop your picture into the room, and we're going to have a talk. And we're going to say, all right, Victor, let's see what you did. Victor, you had all the momentum in the world, and it had the potential to break. And you took a pullback to an area right in the retracement zone, and all that momentum took you to the promised land. Victor, this is a beautiful trade. Victor, this is the one that belongs in your trading plan. This is your pattern. And guys, this is the pattern that we're going to talk about today. Victor, great execution. So Victor will go to his spreadsheet, and he will drop that picture in, and he'll say, man, the feedback from class was this was perfect. What a great trade. Way to take advantage of those advantages and find a way to make some money. If Victor had made a mistake, if he had a misread, he would have gotten that feedback as well. And maybe Victor's trading into termination conditions. Maybe Victor's holding too long, jumping in too early. Sorry, Victor, thanks for being my example this morning. Victor's going to get that feedback as well. So by recording the feedback from class, by talking about your advantages, what you're doing is you're identifying things that are working. You're identifying things that aren't working. You'll find that following rules keeps you relaxed, and you'll find that breaking rules, you start to get antsy and nervous, guys. But if you do this every morning, 3 minutes, probably what it takes. What did I do yesterday? How will it serve me today, guys? It's going to accelerate the learning, and it is going to get you where you want to be and focused on the day. So learn 3 simple rules, guys. We're about to go through them. Simulate, practice, and post. The people that post the most typically make it the furthest, the quickest. And then simplify. Focus on the one trade. Learn these couple advantages, understanding that you will grow outside of it as you learn to read your charts. We're going to break the rules down individually. We're going to talk about them. And remember, you're going to have to do the work to get to where you want to be. But momentum is the easiest lesson you're ever going to learn, guys. So the large chart is going to define momentum and path. The large chart is going to define direction. So guys, there are 2 looks that your trigger is going to have. You're going to have triggers up, smalls are green, large are green, background is green. This says up. Green is up, red is down. Strong triggers, rule number one being met, means that your small triggers, the faster moving average, has broken away from the large triggers, your slower moving average. And that space that's created between the small and large, when all your indicators are green, lets you know that the odds are favorable for the market to continue up. This is your strong trigger look. You're going to hear it annotated and see it annotated in the room, OFM, odds favorable momentum, guys, and that should paint a picture in your head. This is a market that's going to be hard to stop. This is a market that has the potential to break through key areas. This is a market that may even cover some of the mistakes that I might make as a new user. In a downtrend when the background is red, small and large triggers are down, they're red. Space between the two, this is your strong trigger look, and this is odds favorable momentum. The odds are favorable for that market to continue down, guys. And rule number one is something that happens all day. Smalls above the large, space between. Can you guys give me a Y in the room? If you see that I do have strong triggers, I'm looking at the first bar on my large chart. That's all I need to identify this advantage. And once you understand momentum, ladies and gentlemen, we have to make sure that there's nothing in the way, because every horizontal line on the large chart is right where that large crowd, the people in control, are most likely to make decisions. And you'll see that support stops the market. You'll see that yellow 1-to-1s can stop the market. You'll see that divergence lows and divergence highs can stop the market. And guys, you know about these lines long before you get to them. So what you're going to be able to do is you're going to be able to say to yourself, okay, I have the advantage of momentum. I have a market that's likely to continue. But did I reach one of these areas? Did my price bars, did the people in charge get to a decision-making zone, guys? And if they do, all you have to do is count triggers. All you have to do is count how many lines have made it through that area. So every time the market reaches a line, if it's resistance, if it's a yellow 1-to-1, if it's a divergence high, I want you to count your triggers. Ask yourself, how many triggers have made it above resistance, guys? And if the answer is 0, if 4 trigger lines, too small, too large, remain below, this is an area that could stop the market. This is an area that may produce a bounce. This is an area that it could break. And I want you to accept, it's not the same, Paul, not the same. I want you to accept that in the moment, that's an area that could stop the market, and any forward progress could be halted. And if it comes down to support, count your trigger lines. And if 4 triggers remain above support may stop the market, may create a bounce that you can't survive as a day trader. It could break. You'll never know what's going to happen. But this look says pump the brakes, sit on your hands, let's wait for just a second. If the area is going to break, we're going to start counting our triggers as they get through the area. So initially, 4 lines remain below these yellow 1-to-1s. We're going to say, hey, no long trades. Rule number 2 is not met. You can see how it stopped it to the tick right here to the left. If 2 trigger lines break above these yellow 1-to-1s, 2 trigger lines says, okay, this area has potential, but it's less likely. It's not my best look. If 3 of the 4 trigger lines break above those yellow 1-to-1s, now that potential is picking up speed. Now your moving averages have almost breached the area. This is your best of the best look if you're going to try to trade that breakout. And then once 4 triggers get above these yellow 1-to-1s, that area behaving as resistance now behaves as support. The path is now clear, and it remains clear until you reach the next area. So once again, let's go to that large chart. The momentum is present. This is the most current bar on the large chart, giving all this information. Do you guys see the momentum? Smalls above the large, space between the two. Commit this look to memory. This is your momentum look. But since we've reached a fib because we've reached a divergence high. I have two triggers above and I have two triggers below. And ladies and gentlemen, would you call this a clear path? Would you call it a termination condition? Or would you say this area has the potential to break? Give me I guess a C for clear, a P for potential, or a T for termination in the room. And let's see how we're doing with it. Perfect. It is the potential to break. And guys, potential is just that. It's only potential, which means that my path isn't clear yet. And if we go back to that very basic idea that the best trade is momentum clear path in an entry area, I'm missing my clear path. I'm already in a medium probability trade, which means I'm going to latch on to momentum and make sure that it's the best. And I'm going to make sure that my entry area gives me a low risk opportunity. One of the biggest killers of the potential to break is this divergence right here, guys, because divergence is a loss of momentum. So on the plan that I give you, the KISS plan designed to optimize your chances of success, it says if divergence prints when you have the potential, this is a pattern that's less likely to break the area than it is to continue to push lower, maybe beyond your entry area. Does that make sense, everybody? When you know what you're up against, you know what you're looking for. So when we get on TradingView, Dip, it's a little bit different because these triggers are slow. Your large chart is a 15-minute bar. And what you're going to find is when you're looking on TradingView, let me get to my picture real quick. You will start with momentum. You'll be able to recognize the exact same look. Smalls below the large. Guys, this is strong triggers. But because it's such a slow chart, Dip, you're also going to determine where you are in relation to the small triggers. Strong side is left of the triggers. Transition may have to manage a little more assertively, is in the triggers. And then weak side is to the right of the triggers. And this is where everything has to agree. So when I'm looking for my large chart and I'm talking about areas, and this is a great example right now, do you see how the actual price has not broken above the area yet? It hasn't gotten above. They're back below. Samuel, you can do whatever you want. That's the great thing about day trading. It's an individual sport. The plan that I provide each and every day is based around a 15-minute and a 1-minute. So, Dip, if we go through this look right now, my trend is up because it's green. My smalls are up, and I can draw an imaginary line off the top line, and my price is on the strong side. And even though all the triggers are below, do you see the top of the zone here? These zones are big. That's from 73 all the way up to 84. The general rule of thumb, Dip, is if I take an entry long based on triggers lines, it needs to come from above this zone. So triggers, because it's such a slow chart, they're going to define your momentum, but they're not going to be as accurate as Rinko because it's a much bigger picture. So what you can do is you can say, I see my zone, I see my trouble, my triggers are in favor of longs, but if I take an entry, I want that entry to come from above my trouble zone. Understanding that it is a slower chart. So what you can do, and this is a great example, if I put this line right at the top of the zone, you can see that the small triggers are down on the 1 minute, that the push has gotten back below all the trouble, and no entries from below. So this never gave you an opportunity. Does that make sense, Dip? It's a different look on TradingView, guys. But you can see the trigger lines will tell the story. The zone did hold. The triggers never broke. And the triggers never got above until they finally did. But what happens, and there we go again, the triggers don't break. You can use the triggers for the big picture, but you're going to have some in the moment where you're going to have to make decisions. And that's where these zones and the price relationship to the zone is going to pay dividends. They tried to break, but they're finishing below. So no long trades. And now they're getting to the weak side of the triggers. And these 15-minute bars take a little more time. So let me go back to this picture. And it takes a couple days. So when I go through this process, what direction is the market going? It's going down. What direction are my small triggers going? They're going down. Where am I in relationship to the triggers? And then the final question that I ask myself, is there anything in the way to kill my forward progress is the easiest way to say it. So when we go back to the live market, my smalls were up. I was on the strong side of the smalls, but I've got a giant zone in the way. And that zone can kill my forward progress. Does that make sense? So go through the triggers. And let's see if crude oil. The trend is down, but the smalls are up. And even though the triggers are well below, we would look for an opportunity to get to trouble based on the triggers. And because we reach trouble, no long trades. So where price is in relationship to trouble will give you an indication before the triggers will. It's a little quicker way to look at it. And what you'll notice, see how it tried to break and then price went back below, and it tried to break and price went back below, and it tried to break and price went back below, and you see it again and you're seeing it again. No matter what the triggers are doing, the zone says don't trade into it. Wait for that clear path. Wait till you get to the other side. Does that help? I realize sometimes we go through, I want to, these tails are very telling. Tried and failed, and then once the whole body gets below, that's when it continues down. So here's our trouble, and here's price caught in trouble, below the one-to-ones. So what I'm saying is there's no reason to trade directly into something that could stop the market. It's just two different looks, guys. One of them is Rinko, and this is so fast that triggers tell the whole story. And the other is minutes, and because minutes are so slow, it's going to be just a shade different. So let me find. If I were looking to trade from the strong side of the triggers, with the triggers up, I could say to myself, whoops, don't trade. That was not the right one. I could simply say, don't trade directly into something that could create a problem. My trigger set up, I'm strong side of the triggers, but there was something in the way. And when there's something in the way, it could create a bounce. Your triggers won't tell the story fast enough. But where price is in relation to the trouble will. Sorry, that was a little digression, guys. Termination conditions. We're talking Ninja right now. Wow, I lost my whole train. Sorry. Termination conditions can stop the market. And we're talking Ninja. We'll go to TradingView and find more examples. Dip. And one thing that you'll see that'll help a little bit on this trade journal, there's a little discussion on using termination conditions as well. But Sorry, that probably confused the hell out of everybody in the room. My apologies. Strong triggers. Sound is on. Can you guys hear me? Strong triggers lead the way. Once I have strong triggers, is there anything in my way to spoil my good time? Once I have that clear path, we're going to define an entry, guys. And entries are precise. Entries use that smaller, faster chart. They rely on the fight from the small crowd. And your entry rules define right where they're most likely to lose, right where the large crowd is most likely to win and take back over. So the entry rules are so specific that you're going to use a limit order, which means you're going to be able to wait for the market. And you're going to use a limit order to buy or sell a pullback. That pullback is the tiny retracement counter to the uptrend, to the momentum, to the clear path. And you're going to buy or sell that pullback at an area, and it's going to be a fib, a mid-band, or a yellow one-to-one. The same way they can stop a trend on the large chart, they can create that bounce in the direction of the trend on the small chart. And the key is that those areas are inside of triggers, guys. Triggers are moving averages, and on both the large and the small chart, the mathematical term regression of the mean, I learned that, means that price is likely to return to the moving average. So we're going to use the large triggers from both charts to define the retracement zone, to define where that push down is most likely to go. So on your small chart, you're going to see these very smooth. This is your 5-1 triggers. When you compare them to the small triggers, you can define momentum. And there's also stepped. And these are what we call synthetic triggers. And synthetic triggers are the large triggers from the large chart. So your best of the best look for entry is to buy or sell a pullback at an area, fib mid-band yellow one-to-one, inside of those trigger lines, guys. And the tighter the large and synthetic are one on top of each other, the higher the accuracy, the less risk that you're going to have on the trade. So in an uptrend, in a long trade, when everything is up, when the momentum is strong, when the path is clear, you'll wait for a reversal bar on the smaller, faster chart. This is the beginning of the fight, guys. The reversal bar is not your entry. The reversal bar says, hey, here comes the retracement. And you can define where the retracement is most likely to go using large and synthetic triggers. Large can be above the synthetic, synthetic can be above the large, but anywhere from the top of the line to the bottom of the lines, that's where these down bars are most likely to go. Trades are originating at the areas inside of the triggers. Fibs, mid-bands, and yellow one-to-ones. Sometimes there's multiples, which means it's going to create a window from the highest point to the lowest point. Now, because the large chart has strong triggers, because the large chart has nothing in the way to create a bounce, you're going to activate your limit order just above the highest point of support, and you're going to hope that the people fighting have it in them to get down to your great entry. This is the entry for the high probability trend trade long. It may go to the yellow one-to-ones. It may go to the bottom of those triggers. But this is where we're going to try and catch it so we don't trip over a couple pennies trying to save a few dollars. If the retracement is able to go through the mid-band, through the yellow one-to-ones, beyond the bottom of the retracement zone, it ends up where the market should not go. And if this is going to be one of those 70 to 80% winners potentials, you're going to be able to use where the market should not go for stop placement. And any line outside of those triggers is not a part of the window for a short trade. Reversal bar begins the pullback, is not your entry. The retracement is defined through trigger lines, and the potential bounce point is defined from areas within triggers. Fibs, midbands, or yellow 1-to-1s. This is a magical moment where there is one line inside of triggers. You're going to activate a limit order a tick or two below, and you're going to understand that because you've defined where the market is most likely to continue with the trend, you understand completely where the market should not go. The wrong side of the triggers, you will not know if, when, or where that market is going to reverse and go down once you get beyond the retracement zone and the areas within. So you're going to use that idea for initial stop placement. Your initial stops are going to be placed where the market should not go. 4 to 5 ticks beyond those triggers. And why 4 to 5 ticks, guys? I'm always 5 ticks. These are moving averages. And as effective as these moving averages are, you may get a tick or two below. You may get a tick or two above. So we're going to put our stop where the advantage of rule number 3 is no longer in play. And that is the high probability trend trade. That is the best of the best. And you can study it when you see momentum, when you haven't quite reached the area and there's the potential to break. You'll notice that the market pulls back right to an area, right in the retracement zone, and finishes the move down to the fib. And when it gets to the fib, none of the triggers break, which means that fib is a termination condition, and that's precisely where the reversal happened. And from the reversal, odds favorable momentum, potential to break, 2 triggers. There's your pullback directly to the midband inside of triggers, and it finishes the move up to Fibonacci resistance. I think that's the one that Victor took. So guys, all we've talked about for the first 30 minutes is one pattern. One pattern that you can prove wins more than it loses. One pattern that is repeatable, that you can study historically, that you can commit to memory. And from this one pattern, you recognize the 2 most important advantages that you can have in a trade. And once you have momentum and path, you will be able to find entry. Are there any questions about momentum, the separation between the small and large? Are there any questions about defining your path using the trigger lines and counting them? Are there any questions about pinpointing your entries on those pullback to the areas inside of triggers? This is your pattern, brand new users. This is the pattern that is described in the plan that I'm about to give you. So you NinjaTrader users, this is the KISS plan. And this is a stepping stone on your journey, guys. And it's designed to optimize your chances of success with the high probability trend trade. So if you're brand new with me, Eric and Dip, and who else is new in here? Do I have any other new people? Guys, this is your first trade, not your only trade. This isn't your get-rich trade. This is the trade that teaches you to recognize the advantages to find your get-rich trade, guys. And you will write your own plan based on simulation, study, class feedback, and continuous practice. But until you're capable, this is going to put you in a position to win more than you lose potentially, which is exactly what we want because confidence comes from the memory of success. So it's only 2 charts. 13.2 will define the momentum and path. The 5.1 will be used to pinpoint entries and to manage your trades. So you're going to define your entry. Your entry is nothing more than a checklist, guys. And it says, because it's the best of the best, the first thing on the checklist is the market coming from a strong top or bottom? And you've got to understand termination conditions to see this. If a termination condition reverses the market, it's a strong top. It sets you up for the highest probability trend trade ever. It's also rule number 1 for potential to break trades. If a termination reverses the market, large triggers roll from red to green. Now it's a strong bottom. Market's more likely to go the other direction. It's not mandatory for a high probability trend trade, but it does increase the likelihood of success. And remember, the KISS plan is designed to optimize your chances of success. It's going to ask, get over here. Do you have odds favorable momentum, strong triggers? And then it gives you a picture of exactly what it looks like. to have those strong triggers, a picture to burn into your mind, to believe in the advantage. It also shows you what it looks like to have weakness. And if you have strong triggers, it's going to ask you, are there any termination conditions? Well, the picture says that if price reaches support and all the triggers are above, this is a termination condition. Wait to see what the reaction is. No trades into the area. If the smalls absolutely smash through, we're counting triggers, have that momentum. We can take the potential to break trades, but they must be managed assertively. And the path is clear once small and large get below support, which behaves as resistance, and rule number 2 is met. And then it asks you to find area inside of favorable large triggers, and there's your pictures for entry, guys. Nobody in the history of this checklist has ever followed it truthfully and presented me less than 70% winners. I don't imagine anyone in the room will do the same. And guys, this is your first trade. This is your best trade. This is the trade that teaches you to read your indicators. This is the trade that is going to put you in the best position for management. And the management in the KISS plan, let me figure out which one we're at, is just as mechanical and pragmatic and emotionless as the entry. So I'm going to go through the KISS management plan. If you enter the market 2 ticks below the area inside of triggers, then your stop is 4 to 5 ticks beyond the triggers. This is where the market should not go. Good morning, Pibbies. You will know your risk before you ever enter the trade, guys. You will understand exactly where your stop goes. You'll be able to do the math, and you have to be okay with $150 per contract. Good morning, John Novak. Because if you put your stops in the retracement zone, if you put your stops at the areas likely to create a bounce, they're likely to get hit only to watch the market run without you. So stops where the market shouldn't go. And in the KISS plan, your targets are predefined at $100 and $200. You're learning through this very basic plan, stop placement, and you're learning how to get paid, guys, because most new traders want to buy the mansion on day 3. Money in the account, bird in the hand, all those cliches. If you're not stopped out, and you will be stopped out, losses are a normal part of a positive equity curve, guys. We're trading probabilities, and this is a pattern that gives us an edge. If a reversal bar prints in the direction of my trade, my new stop goes 2 ticks above it. This is where the market should not go at this point, because now it has confirmed that it's going down with momentum, down with a clear path, down with the area most likely to create the down. It doesn't guarantee a winner, but now I have $30 risk per contract. And the idea behind trading is that I want to give away as little as possible, but I want my stops to make sense. Targets are still $100 and $200. If I'm not stopped out, it means that it went to my first target. My first target was $100 in the bank. Good afternoon, Miss Jen. Once it hits it, 1 contract is removed. That's it. It's money in the bank. It's mine. It's in my wallet. Life is good. My palms stop sweating, guys. My pulse begins to calm. And I'm going to move my stop to break even. And this break even stop isn't necessarily where the market should not go. This break even stop is designed to remind you that with this much momentum and a clear path on the large chart, that market is more likely to go down than up. So if it doesn't get me break even, that market went down. And it went down to my second target. And my second target was only $200 away. And that's a $300 trade in a matter of minutes. It may have taken an hour to set up, but it's $300 in a matter of minutes. And guys, if that's the best you can do each and every day, that's a $75,000 year. Find an extra $100 every day. That's a 6-figure year. So the idea behind what I do each and every morning isn't to teach you every trade. It's to teach you the best trade. It's to give you all the tools you need to be successful with the software, to find consistent winners, to take consistent profits, to learn how to get paid. So learn the trigger line and the rules for when it's okay to trade. Simulate your trades daily. Practice these patterns. Go back and study these patterns. Prove to yourself that they win more than they lose, and you'll never hesitate on your entry. Keep it simple and focused in the beginning with the understanding that there's more out there for you, guys. And post. The people that post the most make the most. The people that study the hardest get the best grades. The people that commit to advantages usually end up where they want to be. I've been watching it for years, guys. So that is the first part of class where we talk about the three concepts. And guys, now I want to go into TradingView. So TradingView is just another platform. It's Nexgen indicators. And on TradingView, it is 99%, well, maybe 95%, the same as NinjaTrader. When you talk about the indicators, you're still going to use trigger lines, and they're still going to define momentum. You're still going to see divergence, and it's always a loss of momentum. You're going to recognize one-to-ones. These can stop the market. You're going to see mid-bands, same thing, change color with price location. But the difference for now is that we're using zones. We're using supply and demand zones, and these are the areas that could stop the market. Behaving as support and resistance. We're going to treat them like those Fibonacci areas. So your 15-minute chart will be your roadmap for key targets, turning points, terminations. Your 1 minute is going to define the immediate strength in the market. It's going to define entry points. So entries are taken from mid bands for trend trades on the 1 minute. HVA lines when a zone holds and your small chart reverses. And HVA lines and zones for momentum trades, guys. And here's your checklist for the trend trade, for the HVA trade, for the momentum trade. So dip, if we go back and look at the checklist, this is what I wanted to get to. Notice that it doesn't say triggers. It says not trading directly into zones, not trading directly into areas. So you're going to ask yourself on the 15-minute chart, do I have room to get to trouble? For the HVA trade, the zone has been reached on the 15-minute chart, and that's going to help you take advantage of going the other direction. And then on the momentum trade, making sure you're not trading directly in a zone. So it's going to be a little bit different, dip, and it's going to revolve around price location. And this is the NASDAQ. And you can see that they did get above this trouble. They did get above this divergence high, but they traded smack dab into these pink one-to-ones, and that's exactly where the market started pushing down. So if we're looking at the trend that's up, the small triggers are up, we're in the transition phase of the triggers, and if I'm going to think about taking a long trade, I need to be on the good side of this divergence high. I need to be above trouble, not trading directly into trouble. Does that make sense? Which means my entry needs to come from above 97. Awesome. So it's a little different. It's a little different. And guys, I made two pictures yesterday regarding the entries on TradingView. So if you're looking for a trend trade, if you're looking for a pullback to a zone, and on your 1 minute chart, the small triggers are against your trade, wait for the close on the correct side. There's no reason to fight these small triggers. These small triggers win more often than they don't. The other entry is what we call a momentum style entry. And when there's nothing in the way on the large chart and you have that strong trigger look on the small chart, that's where you'll just sell the zone. The pullback comes right to the zone, right to the HVA, right to the one-to-ones. Your entry is right there waiting for it because the momentum is down, the momentum is strong, and you have room to the next trouble area. So two types of entries. I dropped them in the room earlier. I'll drop them through right now. So as we go through the day, the rest of the day is going to be live market reads. The rest of the day is going to be looking at a large chart and saying, okay, it is still momentum and it is still only the potential to break. And with that divergence on the potential to break, they still haven't broken. And it's just a pattern and it's a recipe. And when we go to the S&P, you had the momentum, 3 triggers through. Is it just me? Or did that pull right back to the area, right inside of the triggers, and they couldn't make it 5 ticks below? Eric TK, do you see it? Pibbies, do you see it? Andy Victor, I know you're there. Estefania, do you see it? Samuel, Steve Matthews. Guys, this is your trade. That's the one. That's the pattern. Over and over and over. And all you have to do is commit this look to memory. And the more you study it, and the more pictures you take of it, and the more pictures of it that you look at this on the spreadsheet, guys. From the client trades, momentum, 3 triggers through, pull back to the area inside of triggers. This picture is from 2021. This happened 3 minutes ago. It's just a pattern, guys. And this is what Nexgen teaches. This is what I teach each and every day. Here's your advantages. Here's how you define your entry. Absolutely, Pibbies. So if I have momentum, I had a little consolidation. And Eric, it's going to take a little bit of time. I promise. Let me show you the picture. I used to show this every morning, but I thought that I was scaring people. The first 2 or 3 days with Nexgen feel like this guy right here. And I know that it does. You're drinking from a fire hose. There's a lot of information. There's a lot of terminology. And you're like, oh my gosh, I just want to make money. And I get that. And I've been there. I've been right in your seat, Eric. So one of the great things, I think it's great, maybe it's just me, I could be mistaken, is that we try to break it down into the individual parts that create a trade rather than breaking it, saying, hey, here's your trade, good luck. So every day, you can take kind of this little stroll and focus on momentum for a day. Right? Make sure that you say, okay, small's above the large when everything's green, that's momentum. That's my strong triggers. Small's below the large, there's my space, that's momentum. And give yourself a day, 2 days, 5 days, however long it takes you to be able to recognize in the moment that small triggers below the large triggers is your momentum look. Does that make sense? So instead of taking the pressure off to find the trade, find the momentum first. And then once you have momentum, every time price reaches one of these lines, count your triggers. And if only one trigger line is through, it doesn't even have the potential to break. When 2 trigger lines are through, now it has the potential to break. And if that potential is met, if they are actually going to break, the most likely spot for a bounce on this smaller, faster chart is going to be defined as an area, fib midband or yellow 1-to-1, inside of trigger lines. So Pibby, first it's momentum, and then it's counting triggers. And guys, once you have this look, momentum, potential to break, if I get a reversal bar on my smaller, faster chart, then the most likely spot for a bounce is going to be that midband or this fib inside of triggers. And by defining where the market is most likely to continue, I can also define where the market shouldn't go. It shouldn't get above this trigger if this is going to be a winner. Does that make sense, everybody? First, it's momentum. I only have the potential to break, only 2 triggers. If it gets 4 or 5 ticks above these trigger lines, guys, that's the end of it. If it doesn't, and I get a reversal bar, I'll reduce my risk a couple ticks behind the reversal bar. This is your KISS plan, guys. Doesn't guarantee a winner. And only 2 triggers isn't the best look. 3 triggers is better. But I don't mind taking a loser in the room as long as the rules are met. And we'll see what happens with this one. They may come get us. There we go. And they did. But it doesn't change the pattern. So what you have to do is first identify momentum and then count your triggers. How many triggers made through? And I'm going to remind you that 2 triggers has the potential to break, but it's less likely. 3 triggers is where you have a higher chance of success. And if you go back to the very simple plan that I gave you guys, The KISS plan tells you 3 or 4 trigger lines through the area to optimize your chances of success. So what I did, and my brother's going to be mad at me, is I strayed from the KISS plan with that potential to break, because what I wanted you to see in the moment, I lost Ninja Trader, wasn't the wins or the losses, but where trades come from, what it should look like as you get into them. You would think the resistance is the divergence in the larger chart, but Samuel, I agree with what you're saying, but the challenge is that divergence doesn't print until 2.5 bars up, which means that that divergence wasn't even present until after the entry on the small chart. So what I'm looking for on the small chart is if there's divergence on the small chart, that could be a red flag. And what we have, guys, is a market that's just consolidating a little bit. The buyers wanted it to go up. The sellers wanted it to go down. My indicator said the sellers had an edge, that I had an edge, but somewhere large crowd buyers decided they weren't ready for it to go down. And guys, I would take this loser every day. I would take this loser each and every day if 3 triggers were through, because it fits my plan. But since it was only 2, it wasn't the best of the best look. And watch this. Once my triggers are done calculating, you'll notice that on the previous trade, it was 3 triggers through, and it creates an advantage. So, but what we were talking about, because Pibby's was asking just about the entries, I wanted to go through. That's your pattern. That's where the market shouldn't go. And look at this one with 3 triggers through. That's the one that worked out. 2 triggers through, it didn't make it. 2 triggers through, it didn't make it. Absolutely. Samuel, entries are 100% small chart. So when the large chart says that you have momentum, when the large chart says that you have a clear path, let me find a good picture for you here. No problem, Samuel. So this is a great picture and a great study tool for you guys. Do you see the momentum? And guys, we're talking about this bar right here. That's what it looks like when there's 3 triggers through, when the momentum is strong. Guys, once I have this look, the market's trading at 97.05. But I'm done with the large chart. I don't need it anymore. Don't even have to look at it. From the top of that large chart bar is the beginning of the retracement, is the entire pullback, and is the bounce in continuation. On the large chart, notice that momentum never changes. On the large chart, notice that path never changes. And inside of that one bar on the large chart is all of that information. It looks like a tail on the large chart, but we don't trade the tail, Samuel. What we're doing is we're refining and defining exactly where that tail is most likely to form. So once the large chart rules are met, I go to the small chart and look for an entry. Does that make sense, everybody? And it's that refinement process that allows us to reduce risk. And it's that refinement process that allows us to pinpoint entries. So if we go back again, so the large chart is on the left, Eric. It's a 13.2, and all that 13.2 is it's a description of the number of ticks it takes to create a new bar. So inside of this one bar on the large chart, there's your pullback to the areas inside of triggers, doesn't get 4 or 5 ticks below, and there's your continuation up. So it is an awesome refinement tool. And notice that when this chart bounced off of 1-to-1s, when this chart had its small triggers turn, right? When this chart gave 15 down bars, your large chart never blinks. And this is why the large chart leads the way. Because the large chart is going to define the direction. It's going to define the momentum. It's going to define the areas that are problematic. The small chart's going to refine that very broad stroke of a brush, and you will pinpoint right where the market is most likely to continue. Does that make sense, Eric? So it's 3 pieces. That's it. 13.2 is large. 5.1 is small. And I use the phrase large and small. Big, slow, broad stroke of a brush. Small refinement. You don't even have to know the numbers to be successful with the software. You don't have to know what creates a fib to be successful with the software. You don't have to know the numbers for the moving averages to be successful with the software. Just got to learn a pattern. And Eric, I'm not sure how old you are, but I was born in the 70s, played video games in the 80s. And in the 80s, if you followed a pattern on a video game, Pac-Man, Defender, Galaga, all those great games, if you just followed a pattern, you could play for hours on the same quarter. And when you deviate from the pattern, you're less likely to win. You get killed, you get shot, you get eaten, whatever the case may be. So we just keep going through patterns. If I have momentum, smalls below the large, then I need to define my path. And since price made it to this blue fib, this is where I'm going to start counting trigger lines. With only 2 through it has the potential, but it's not very likely. I really want to see 3 trigger lines through the area before I consider taking the trade. Up here, 2 triggers through. It could break, but it's not very likely. And one of the biggest killers, and we're about to see it both directions, divergence on a smaller, faster chart. Loss of momentum on a smaller, faster chart is one of the biggest killers of the potential to break. So the KISS plan says if divergence prints on the smaller, faster chart, no trade. And we'll see what happens. Only 2 triggers, and it's not only 2 triggers through this fib, it's only 2 triggers through this fib. And it's only 3 triggers through these 1-to-1s. Divergence prints. They're nearing the top of the retracement zone. And sure enough, they are off to the races up. So, avoidable losses. Avoidable losses drain accounts, guys. And that's what the KISS plan is designed for, Eric. It's designed to give you something to follow as a brand new user that's going to teach you to read your indicators. And then once you learn to read your indicators, you'll get to create your own plan based on what you see. And this is a great segue as we go into the second half of class, where all we're going to do is live chart reads, and all we're going to do is review presented charts. Because every chart that's presented in the room, what we're going to do is we're going to go back to momentum, path, and entry. Every time we're going to go back to momentum and path and entry, whether it is TradingView, whether it is NinjaTrader. So for example, here's Paul, first post in the room. Paul has downtrend, small triggers down, strong side of the small triggers, and he gets a pullback right to the mid-band, right at an HVA, and Paul gets in a shade early per the plan, but with this many areas of resistance, in a downtrend with small triggers down, he takes the trend trade. And I believe that one made it to his target, but it's all momentum first. What color is or direction? What color is the background? Small triggers, what direction? Where is price trading in relation to the small triggers? Is there anything in the way to mess up my good time? Beautiful trend trade, Paul. Really nicely done. So every chart presented in this room, we're going to go back to those things, guys. We're going to go back to momentum. We're going to go back to path. We're going to keep revisiting the live market. there's a termination that reversed the market. And guys, sometimes they're not going to give you an entry because the rules aren't met. And I'm going to tell you right now, the most magical phrase to create patience is not my money. Sometimes it's not your money. But if you look at the big picture, from 65.10 to 66.20 is $1,100 worth of movement. And then we've got another $500 worth of movement down, $500 worth of movement up, $400 worth of movement down, another $800 worth of movement up. Guys, over $3,000 worth of movement between midnight and 9 a.m. You need to capture consistently $400 a day to be a six-figure trader. So sometimes it's not your money. Sometimes it's not your move. You don't have to be in every move to find success with the software. Every tick is not your tick. And now you have a recipe to find the best moves, to have the highest chance of success, to avoid the losses that aren't giving you what you need. And once you get to the point to where you're a little more comfortable with everything, you may say to yourself, I have momentum, but my path isn't clear. I can define a low-risk entry. I'm willing to take this medium probability scenario and manage it. And if anything changes on the way up to trouble, I'll manage out of the trade. Does that make sense? So from the basic concepts, from the very basic concepts, you'll know what you're up against. You control the entry, and you may choose to manage a little more assertively. And you're going to see a lot of that in the next 2 hours of the men and women in this room taking trades that maybe aren't trend trades, but revolve around momentum and path, that are momentum trades that revolve around momentum and path. And the study that they put in is how they were able to adjust their plan. All right. That's our first hour. It's pretty much the same first hour every day, guys. I scrolled all the way to yesterday, so let me scroll down. And let's get to presented pictures. So Wayne gives 2. Guys, we're going to go back to momentum, path, and entry every time. Odds favorable momentum. Let's figure out where he was doing it. Over here to the left. Odds favorable momentum. 3 triggers above, almost 4 triggers above. Wayne, you get a pullback right to the area inside of triggers. You say price went out of triggers. That's that 2 ticks, right? That 3 ticks. That's why stop placement goes 4 to 5 ticks below. Gold's a little psychotic. Man, Wayne, super late entry with the perfect look on the large chart. And all you did here is increase your risk. And you pulled about $100 worth of profit out before that fib. Great trade. Nice job. But with this look on the large chart, ladies and gentlemen, buying that area inside of triggers produces, let's see, 80, that's 2, almost $200 extra profit on that trade. Nice trade, Wayne. And then, let's see, jump the fudge in with triggers, rolled on all charts. Smalls are up, large are up, and Wayne just jumps in. With all the strength pushing up, with everything saying up, Wayne says, you know what? I'm going to jump the fudge in once I clear trouble, and I'm going to get paid on the way up. Nicely done, Wayne. And this is a great example, Eric and Pibbies. With a little bit of time in the market, you'll start making decisions based on those core advantages. Wayne, nice trading. Good to see you back in the room, man. And then Paul W., I like that we're getting the mix here. So the 15-minute had touched the zone, which thinking about it, it's not a zone price-wise, not at a zone price-wise. Let's see where you got in. You got in at 96. Okay. One to months, one to above. So you took the short trade from 96, stopped yourself out concentrating on the 15, actually at a zone, 5 tick loss over nothing. So if you were going to take the trade, Paul, smalls are down, large are down. You entered below trouble. You had room to trouble. You're trading off of a zone. Did you go long? Oh, you took a long trade. All right, hold on. That changes everything, doesn't it? So this is a great example. Dip, because of the zone, because it reached the zone, Paul was looking for the HVA trade long, and this is your edge trade, right? But Paul, your entry was at 96, right here, which means that you had 4 ticks potential to get to that trouble right there. Do you see it? Just not much room to make money. And once you get above those 1-to-1s, that's when it really starts to stretch its legs. So that's a good example. Using the large chart zones, do I have room back to trouble? And that's where you just didn't, Paul, and that's what creates that little deeper bounce. Making sure that you're not trading directly into something that could stop the market. And then once you get above it, that market starts pushing a lot harder. Good stuff, Paul. Great picture. Dip, that was a good example of what I was trying to explain earlier. So, Paul, I owe you one for the great picture. All right, and then Victor, and I love this. Victor says, Mark, I just want to make sure that I'm defining my entry area correctly. I want to make sure that I'm using the language. And strong triggers, 2 of them are through. And Victor says, all right, if I get a reversal bar, look at this, guys. He's calling his shot before it ever happens. If I get a reversal bar, the market is likely to retrace somewhere between the top line of the triggers and the bottom line of the triggers. The market is most likely to bounce at the areas inside of the triggers. Look at that window that he created. Before the reversal bar ever printed, Victor knew exactly what he wanted. He knew exactly what he wanted to see. He knew exactly where he wanted to enter that market. And Victor called his shot based on a pattern and took profits up to the fib. So when I talk to you newer folks, Eric, and I know that it's overwhelming and Lost and Pibbies and everybody, that's the look. And it's pretty cool. You will call your shots. You will demand that the market give you what you need rather than just hoping that the market does what you want it to do. And Victor, absolutely beautiful job on all of it. All right. Miss Estefania, taking a little different look here. Miss Estefania says, check it out, Mark. A termination reversed the market. It gave me all the momentum I could ever hope for. And I didn't want to get in directly into trouble. I wanted to get in on the other side of trouble with all this momentum. And I'll just get out, make some money. And when I get to all the trouble, if I lose momentum, I'll get out of the trade. Estefania, beautiful. Guys, look at the momentum on the large chart. That's the core of what she's looking for. She identifies trouble, and rather than trading directly into trouble, waits for price to get to the other side. And now she's saying, I'm just going to ride that momentum until that momentum goes away. And that reversal bar that finishes on the weak side of these small triggers that are down and strong, that's her loss of momentum. And that's exactly where the big retracement happened. Estefania, this is a beautiful, beautiful example of taking those 2 core ideas and translating them into a beautiful trade. All right, Victor. Strong triggers, Clear path, 2 triggers through. Next trouble is higher up, space for profit. Entry area inside of triggers. Let's see how it develops. I love that you put this. Let's see how it develops. Does everybody remember what I said is the biggest killer of when it's only the potential? What is the biggest killer when there's only 2 triggers through, not 3 triggers through? And Victor, what you did here is you gave everybody an outstanding lesson, because there's the same look, and there's your divergence, and then there was the second divergence. Victor, get out. And then there's the third divergence. Victor, what are you doing? And sure enough, it pushes down. And I'd love to see how you manage that one. Do you have a management picture in there for us, Victor? Because your entry's Rockstar, right? Oh, there it is. And here's the update. Entry is Rockstar. Stop makes sense. And you get out for a little bit of money and break even. So Victor, you took a medium probability scenario. You managed it assertively. You made a little money on a trade that fails, and you protected your investment. And guys, because you know what you're up against, you know to manage assertively. Victor is going to teach the room next week. Just trading patterns. Great job, Victor. Strong work. Strong work. All right, Hunter. Strong triggers. 3 triggers through. Perfect pullback. Easy money. Newer users, are you starting to see the pattern a little bit? 3 triggers through with momentum, no divergence. He mentions it because it's important. Pull back to the area inside of triggers. Stop where the market shouldn't go. Let's collect profits. Hunter, perfect trade. Fits the KISS plan perfectly. Now you guys that have been with me for a while, the KISS plan used to say 2 triggers through, potential to break. John Novak did some study for you and said, you know what? 3 triggers is when life gets good. 3 triggers is when it has a higher potential. 3 triggers is the best of the best. And a lot of you have been embracing that in the room and finding an amazing amount of success. So thank you, John Novak, for that little revelation. Hunter seems committed to 3 triggers. Have you guys noticed that 2 triggers seems less likely to work? Everybody should get a copy of that. There it is again. I try to give it out every day. That's a great picture. And what I'm finding is that you guys that are really latched on to that 3 trigger idea are finding a pretty awesome amount of success. Miss Jen, weak bottom, odds favorable. Saw 2 triggers through. It's actually 3. Pull back to the area. Because you saw 2, you entered on the up bar. And you still got paid at trouble. Beautiful job, Miss Jen. It's almost like you and Hunter are in the same house, doing the same thing, with the same charts and the same plan. Absolutely beautiful. Different rooms though, right? Yeah. Guys, when the mama bear hands the plan off to her cub, you know she believes in that plan. Moms tend to be protective. I love it. All right, John Novak, what did you do? I love it. John's saying I'm going to use Renko and TradingView. Let's see what we have. Termination reversed the market. Everything says up. John takes a pullback to the zone in the HVA. Opportunity to go long. Pull back to the zones in the HVAs. Maybe a close on the correct side of the triggers. And it goes up to trouble. John says 2 longs you got. Out a second one too early because you only had 1 lot on accident. Got the first targets 400. Missed the rest of the run. 400's nothing to sneeze at but greedy. I like that you can admit that you're a little greedy. Was only the minutes. That's all you need. Everything is up. His entry came above trouble. Pull back to the areas. With all triggers up, he bought the HVA. When it came back, same area. Nice. Oh, and that's the lookalike on Ninja. Look at that. HVA. Rockstar. I don't care what platform you're on, guys. You're going to find a way to make money once you learn to read your indicators. Oh, Estefania, Ron stole your trade. Do you see it? Everything says down. Decisions are made at key areas, and Ron says, so I'm going to let the back of the price clear the decision-making zone. And with everything down, he jumps in, rides the momentum down. Base hit times 4 equals $100,000 a year with one trade. I love this game. So again, my newer users, Ron developed this trade based on momentum, path, and entry. Everything that he learned in the high probability trend trade. But this is the most impactful thing right here. $100, four contracts is $100,000 a year in one trade. One trade, shut it down. One trade, go play golf. One trade, go eat pizza with your kids, right? John, there's the actual, there's the entry. There's your exit. I can't believe you chickened out so soon, John Novak. Man, oh man. Sorry, sibling rivalry. You got to egg your brother a little bit. Didn't have the runner contract on, was not chicken. You got paid. Does everybody know what the goal of day trading is? It's to get paid. That's it. To make money. To make money consistently. To take more out of the market than you put into it. That's it. And the cool thing is in order for John Novak to win this trade with advantages, somebody thought it was a good idea to go short so he could enter. Somebody lost a short trade so John can make money with a solid plan. And John says we should have fibs by the end of the month for TradingView. How cool is that? Fibs by the end of the month. I'm pretty excited about that. If you've ever met my brother, if you've ever spoken with my brother, he has this, I won't even call it a flaw. He is happy but never satisfied. He's in this state of mind where if he can give you guys good, he wants to give you guys great. If he can give you guys easy, he wants to give you outrageously simple. And if you look up, there it is right there, HVNS syndrome. I'm pretty proud of my picture count. I probably take 40 pictures a day. I annotate them, I present them. Guys, I'm at 6,200 pictures for 2025. Last time I looked at John's picture count, he was probably in the 40,000s. Somewhere in the 40,000s. And it's all based on patterns. Here's a good one. If price reaches a mid-band, Fibonacci resistance, and the large triggers remain a full bar away, price, regression of the mean, is likely to snap back and close the gap to the large triggers. Does everybody see it? You had momentum, but you didn't have a clear path. And the only thing this pattern tells you, new users, is that if you try to jump in at a mid-band directly into a termination condition, and you have that gap theory, that market's likely to go back, close the gap, and kill all your fun if you didn't believe in the termination condition. So we do the same thing every day. There's your NASDAQ. Pink 1-to-1s worked. Zone worked. The trend is up. The smalls are up. We're on the weak side of the smalls. And if I thought I was going to take a long trade, guys, I want to get back up above that trouble. Do you see it? I want to get back above that top right there. And if I want to go short, I want to get below the bottom of that zone. I want to get outside of that scramble area, because look at the scramble area. That's where things go sideways. Whoops. Well, that was the one in between the zone and the 1-to-1s. That's where things go sideways. Crude oil had a huge drop off from news. The trend is down. The triggers are strong. We're on the strong side of the triggers, but I just don't have anywhere to go. And sure enough, you can see the bounce. I just don't have anywhere to go. There's something in the way to ruin my good time. All right, guys, I'm going to leave you with crude oil for a minute. I'm going to go stretch my legs. Remember, first it's momentum. If an area is reached, count triggers. If an area is reached, count triggers. When an area breaks, it behaves as resistance. Support breaks, it behaves as resistance. Resistance breaks, it behaves as support. Over and over. So we're just going to focus on some patterns, guys. I'll see you in about 5 minutes. Go stretch your legs. All right, legs are stretched. Guys, I want you to see the last comment in the chat box. The last comment in the chat box says, take enough pictures, it sticks. I can't stress this enough. Take enough pictures and you'll never have a problem recognizing momentum. You'll never have a problem recognizing the loss of momentum. You'll never have a problem identifying termination conditions. You'll never have a problem identifying a clear path. And then once you get those pictures in, and once you start to commit those to memory, you're always going to know what's working for you and what's working against you and how you should manage that trade. So repetition, guys, is the key to recognition. So Ron, Now let me see if I have this clear. With momentum and nothing in the way, you can find a way to get in and get out in between trouble using momentum. You new users, this is called the chili dog. It's crazy talk. And oh my gosh, I hate it. I'm not going to lie. Ron, I hated this trade in the beginning because my brain hates change and Ron doesn't wait for pullbacks, right? Ron knows decisions are made at areas, guys. And when you have momentum and path, you will find a way to make money in between those areas. The easiest trades you will ever take will be trading away from Fibonacci with momentum to Fibonacci. And it's just rinse and repeat. It's crazy, crazy talk. Low on NASDAQ short term, John says. What does that mean? That means that he's in a zone. He's coming from one-to-ones. And if you go through it, the small triggers are turning down, which puts me on the strong side of the small triggers. I'm not going long into a zone, right? And if I decide to go short, I better have room to those one-to-ones. Guys, we're just transition. Just transition. NASDAQ trades a ridiculous amount of money every day. You don't have to trade into these one-to-ones. You don't have to fight these triggers hoping that it breaks a zone. This is that 95% of your day is spent sitting on your hands. 95% of your day is doing nothing. And when you're done doing nothing and the advantages are there, that's when you take a trade, right? That's when you take a trade. So, Paul, strong triggers, 3 triggers through, pull back to the area inside of triggers, easy money, nothing to lose, looking for the home run. Absolutely beautiful. Do you guys see it? All the momentum in the world, almost 4 triggers through, coming from a termination that reverses the market. Look at his entry, like a freaking sniper. And he's up 550 with absolutely nothing to lose on that trade. Beautiful, Paul. Two triggers through, in on the wrong side of the triggers, where the market shouldn't go, and it gets them. You guys see the difference? 3 triggers through, strong triggers everywhere. 2 triggers through, smalls have returned to the large, loss of momentum. Entry is on the wrong side of the triggers. Newer users, this is a great example of how in the beginning, they're going to look damn near the same. But they're not. You're going to bail already, Ron? It's 10:30. Are you suggesting that with a plan, here we go, watch this, this is leading the witness, that with a solid plan, not trading into areas using momentum, you can be at the beach by 11 a.m. eating chili dogs? That's outstanding. Ron, have a great afternoon, man. We'll see you tomorrow. That should be the goal. Get paid in GTFO, guys. Go live your life. Day trading affords you that luxury when you do it well. Can you guys give me a why if you see the difference? It's so important that you understand this. 3 triggers through. Strong triggers. 2 triggers through. Weakening triggers. Wrong side. It's so close, but it is different. So what's going to happen? Those one-to-ones aren't giving up the fight, right? Still caught in the range. Just waiting. Just waiting. There's at least one of you in the room that is saying right now out loud, all of this movement, and I'm not getting paid. All of this movement over the course of 20 minutes, and I'm not getting paid. I may have to make up some new rules real quick. I may have to come up with a different plan on the fly to make sure that all of these ticks don't go wasted, right? I just don't think you need to. You can do whatever you want, but it seems to me that if you just wait for the rules to be met, that's a horrible picture, there's an opportunity. Has anyone not had the next trade show up? I've always had the next trade show up. I've watched the market flatline one time in my life, and when crude oil hit zero. Oh, John, so close. The rules say if an area holds, if the triggers roll, buy the HVA. And the NASDAQ said, sorry, John Novak. We need everyone in the classroom to know that you're human too, right? But the NASDAQ is mean. They may stop the low and get you. They may. They may not. You know where the trouble is, right? Man, that was so close to rules met. So close to rules met. That's market. The market is probabilities. Did anyone watch the video that I posted at the very top of the room yesterday afternoon? I got caught in a Mark Douglas rabbit hole. And guys, there's little shorts on YouTube, Mark Douglas shorts, and it's unbelievable when you hear him talk about probabilities, when you hear him talk about you're not in control, when you hear him talk about how trading is all about having an edge. You identify, you're like, oh man, I really don't know what's going to happen in the market, but I do know that I have a pattern that's predictable. I do know that I have a pattern that can be proven to win more than it loses. And that predictability, that probability gives me an edge. And that's what we look at. And John, that just wasn't your money. Just wasn't your money. But there it is. Whoops. Zone holds, one-to-ones hold, triggers roll, pull back to the HVA, and off it goes. So if you missed it on the NASDAQ, they gave one on the S&P. Oh, no way. Zone holds, triggers roll, pull back to the HVA, and I'll be good gosh darned. So 3 different markets, same pattern. Do you guys see it? Even if you don't understand the trade, zone holds, triggers roll, pull back to that green line. Zone holds, triggers roll, pull back to that green line. Zone holds, triggers roll. Do not give John Novak his money at that green line. But it's the same pattern, 3 different markets. Pretty cool. And you guys have a plan to capture it. Zone reached, triggers roll, buy or sell the pullback to the HVA. All right, guys, it's your turn to talk. We've done our reads. We've looked at your pictures. Every now and then, with 2 divergences, or with 2 triggers through and divergence, every now and then it's going to go to make you question. You're going to have to count triggers, and you're going to say, dag nabbit, that's not my trade. And you're going to say, hold on, I've still got strength, and I've got 4 triggers above support, which means that support's likely to hold, and I've got a reversal bar And I've got an area inside of triggers. And if I get an entry, I know exactly where my stop goes. Do you guys see the pattern? First it's momentum, then it's a clear path. If the market is going to continue up, we can pinpoint exactly where the market is most likely to continue up. Yeah, for zone holds, triggers roll. Oh, let me think which link I had up there. That black screen. It's not that one, right? 2 minutes ago. Did I post it in the room? Oh my gosh. Samuel, we'll get there, I promise. I had it up on the screen 2 minutes ago. Wasn't that one, was it? Oh, so I think what you're talking about, hold on, is the HVA trade. So let's just click on one of these pictures, Samuel. First the area is reached, then the triggers roll by the green line. Is that the picture? It wasn't a trade. Oh no. It was oh, okay. Thank you for that. That's what I needed to know. So what it was, here you go, Samuel. There is the TV plan. So in that document, okay, I'm with. It takes me a second sometimes. Thank you for being patient with me. So in the document that I just dropped in the room, it tells you how to use both charts, where entries come from, and then there's your checklists for all three trades on the plan. And then Samuel, also, there is the spreadsheet that goes with it. And that's the one that has the pictures of the HVA, the trend, the momentum, ideas on management, and even when not to take trades. They still didn't pull back yet, did they? 4 triggers through, smalls outside of the large. If we get in at 89, our stop goes somewhere around 81 or 80. 9 takes a risk on the trade. We'll see what happens, guys. The only way I'm allowed to take a trade is if my rules are met. Didn't make the mid band inside of triggers there. You're coming the full month to success with you. I love it, Samuel. It's good to see you in here and participating. I'm telling you guys, I told this story yesterday, and I'll tell it again. In my previous life, in a previous job, when I went into management, there was a manager, and it's funny because John Novak worked for him as well. And he told me, Mark, there is nothing that you can screw up in this restaurant that I can't unscrew. But he didn't say screw. There's nothing that you can make a mistake on, that you can break, that I can't fix. And guys, I feel passionately about that with you guys. There's no mistake that you can make in this room that I haven't made and learned how to fix. There's no fighting the trend that I haven't fought. There's no trying to go short against triggers. There's no entering on the wrong side. I've done it all, and I know how to fix it. And if you just show me what you're doing, we'll identify your mistakes, and we'll learn how to fix them together. And that's the great thing of the feedback. And then John says, many people start off not serious. Sorry, does that fit the bill? 1, 2, 3, 4, 5, where the market shouldn't go. Clear path. Still have a line outside. There's your entry right at the area where the market shouldn't go, or where the market should bounce. Stop where the market shouldn't go. We already got a reversal bar. Risk is minimal. If it hits the first contract or the first target, we will go break even. If it doesn't hit the first target, we're going to get stopped out, guys. I'm not in control of that. But look at that large chart. That's confidence inspiring. We'll see what happens. Pete, you're in that long? It fits the rules, right? It fits the rules. I'm obligated. John used to tell me, I don't care if it wins or loses. It doesn't matter to me if it wins or loses. But if it fits my plan, I know that I have an edge. If it fits my plan, I know exactly where my entry belongs. If it fits my plan, I know exactly where my risk is. And he used to say, I don't care if it wins or loses. And I thought that was the craziest thing ever. How do you not care? And that's it right there. I would rather take a loser on the perfect trade than to miss the perfect trade. And that's kind of what trading is. This is a pattern that you can prove typically wins 70 to 80% of the time. This is a pattern that you can go back and test. This is a pattern that you can study. And guys, you'll never be in control of the outcome. But everything on my large chart suggests this market would rather go up than down. So I'm going to try to go up with it. Everything on this chart suggested it was going to go up instead of down. And now you got to go through that sting, John Novak, of calling your shot and them not giving you the entry, right? Oh, everything was right, and those sons of guns. Those sons of guns. And now, right to his target. That's the hard one. Whoa, they're bouncing. All right, so the only thing that would take me out of this trade, ladies and gentlemen, would be a third divergence in the same price range. That's an exit condition. 3 divergences in the same price range will be your small chart showing you change that you can't see on a large chart. So we're still in it. Great stop placement. Pibbies, do you see it? Eric, do you see it? With momentum, with a clear path, pull back to the area, stop where the market shouldn't go. And now we're at the mercy. We're at the mercy of the market. It either goes up or down. My big large chart says more likely to go up. If I get a third divergence in the same price range, 1, 2, my stop will be 2 ticks below that reversal bar marker. It'll let me know that it's true. If that negative number becomes true, produces a magenta line, 3 divergences in the same price range is the only small chart termination condition that would make me exit this trade. Otherwise, it has to go to my first target, at which point I'll go break even. Nice job, Pete. So Pete already made 280 on it. Pete's plan is a little outside of the KISS plan. Nicely done. Nicely done, Pete. Oh, there we go. 3 divergences. That's an exit condition. Is anyone going, man, Novak lost again? Happens sometimes, guys. Losing is as big a part as winning. It really is. I would take that trade every time. Weak triggers at a fib. No areas inside of triggers. Doesn't fit my plan. 3 divergences in the same price range. Pushed it lower. And then it went up with the large chart. Man, oh man. Guys, what do you want to talk about? Price reaches a zone. Smalls below the large. I can't go long. It's really strong, right? Estefania, you too. Always good seeing you. You didn't have that first divergence on the small chart, Pete? Right on. What do you guys see? I see trend up. I see smalls up. Strong side of the triggers. But you know what else I see? I see a zone reached. I see the smalls below the large. And I see sell a pullback to an HVA. And that represents all my trouble. John, did you do it? All triggers up, HVA zone works well. Triggers not all up, and zones. Oh, that HVA will no longer work. No more long trades. And John, zone reached, smalls below the large. There's your HVA trade. Here's trouble. But if you got in at 57 and you got in out at 44, first contract, go break even. Pretty awesome. Can my TradingView users give me a why? If you see it. Zone reached on the 15. Let's go to the trading plan. For HVA trade, zone reached. Small triggers turn and below the large from highs. Buy or sell a pullback to the HVA on the 1 minute. Does it fit the rules? That's what I want you guys to see. Does it fit the rules? Zone reached. Smalls below the large. Guys, that is a rock star entry at 56. The low of that bar is 28 points, right to the pink 1-to-1s. Right to the pink 1-to-1s, and that's where it creates a bounce. Rinse and repeat. We're going to have to start playing I Spy, Victor. Guys, it's easy for me. Here, let's go through it. I'm going to do it like this, dip. And I'll put this at the bottom. So first, zone reached on a 15-minute chart. Do you see it? So there's your first yes. Second thing, small triggers get below the large triggers on the 1 minute chart. So there's your second yes. Sell a pullback to the HVA line on the 1 minute chart. And there is your third yes right there at 56. And that's your HVA trade. And the cool thing is that if you have this checklist in front of you, you can run through it. And when the rules are met, you have an edge. You have an advantage. You have a pattern that you can prove works more than it doesn't. And what was cool is John Novak said before the HVA trade, we're not going long here. That's not a long. It was a short. Not now, but later. Can you? Yeah, for sure. So the white bars, we'll do it right now. I don't have any other pictures to look at. And guys, you're going to find that your questions are the most important part of this classroom. So the white bars are what we call breakout bars. And there's a breakout bar there. And you see a lot of them. So what you get is on any of these bars, At that price, more buyers than sellers. At this price, more sellers than buyers. That's what the dots tell you. But what happens with these breakout bars is if this breakout bar is confirmed with a down bar. So you get a breakout down. Oh, there you go. Thank you, John. And then you get another down bar. That's what creates this pink line. When you get a breakout bar from a low followed by an up bar, that's what creates this green line. So these breakout bars give you an indication that not only did the price reach an area on the big chart, but they broke out to the downside. And then they confirmed that breakout with another down bar. And it paints this beautiful pink line for you to use for an entry. Does that make sense? And the dots just show you where the highest concentration were. So one of the things that you'll get on these dots as well, and John gave you the links to it. Let me see if I can find it. Here we go. This is a good example on the breakout bar. So we're going to look at this bar dead center. The video on the market flow user guide is pretty good. The guy who made it rocks. I don't remember making that video, John. So check this out, Dip. You'll like this. Buyers, 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 buyers. A seller. Buyer, 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 buyer. And the buyers tried all the way to the tip top of that bar, but the sellers won. When you see those green dots at the top and you get that long tail and it becomes a down bar, that's what we call stranded buyers. And you'll see the same going the other way. See those pink dots down at the very bottom? Those are your stranded sellers. And the market pushes up a little again, and then it fails, and then it goes back down. And the buyers couldn't complete it. Below it. I go a tick or two below it. And what the HVA line means, and Dip, you'll find the longer you spend with me that I make up stories about what things are. Where was it? So what I'll do is I'll use, this is how it goes in my head, yeah. So I get my breakout bar, and I love it. And I get my confirmation bar, and this pink line represents the highest concentration of sellers on the breakout bar. So that pink line is the line in the sand. If those pesky buyers try to push up, when the rules are met, this is where the sellers are gonna unload. That's the most likely spot for the sellers to just give everything they have to push that market down. So I'll put mine a tick or two below, just in case that the sellers are over caffeinated. And my initial stop, I'll put over the top of that white bar, that breakout bar. And then once I get the down bar, it's virtually no risk. So these pink lines are the, okay, this is where the sellers said no more. And you can see right here, you had a green line where the buyers said no more. And it did create a bounce, but the sellers were already in control at that point. So once I get the white bar and the confirmation bar, I'll activate my limit order. As soon as I see that pink line, if my rules are met, I'll activate my limit order. And this is a pretty good look here. See those 1-to-1s that they got to? Doesn't necessarily mean that the uptrend is over. Look at that green box over here. You could define exactly where that push down was most likely to stop by using those pink 1-to-1s. And that's exactly where it did stop. And then you got your breakout bar, and then it got confirmed, and it created that green line. And then the link that John put above, the market flow volume analysis, is an awesome, awesome watch. And it really does. It was funny. So I started with John, well, in 1972, but started with Nexgen and John in 2020. And he gave me the market flow chart because he understood it. And one of the biggest things about the market flow chart, let me get to the picture because it always cracks me up, is if you try to make sense out of everything without having rules met, you'll find yourself in 1,000 trades. And my first day, I think I took 125 trades. And all I could think is, my gosh, this is the dumbest chart ever. I'm down $27,000 on Simulator because I tried to make sense of everything. Oh, it's green, go long. Oh, it's red, go short. And don't stare at it. Wait for your rules to be met. So market flow is just a tool. If it holds, if it rolls, sell the pullback, but it still goes down to what are you looking for, right? What are you looking for in the grand scheme of things? What is your big picture? And right now your big picture is strong triggers, smalls up, strong side, but I've got trouble here. I can't really take a momentum trade if I don't break and pull back. And if I pull back, 71 is kind of my line in the sand because anything below 71, I get back inside of that zone. So fun stuff. 2 triggers and another failure. Do you guys see it? Only 2 triggers. Large triggers were a full bar away and another failure on trying to push down. Avoidable losses. Your S&P is officially in a strong trending market. 30 plus bars in the same direction. When you see those small triggers riding the large triggers, some of you call it the train track look. You can assume odds favorable momentum. You can say rule number 1 is met. And then if all of the triggers are above trouble, you have a clear path. So the general consensus is in a strong trending market with a clear path, keep buying the mid band until it doesn't work. And you're going to see how this, we'll see if it plays out. But in a strong trending market with room to trouble, keep buying the mid band until it doesn't work. So if you put a limit order just above the mid band, you've got to decide how much you're willing to risk because you're already where the market shouldn't go. This isn't a high probability trade. This is hoping to take advantage of a strong trending market. And this trade will fail eventually. As soon as they decide that their strong trend is over, this is going to fail. Does that make sense, everybody? Strong trending market, 30 plus bars, clear path, buy the mid band till it doesn't work. Where do I want to put my stop? Maybe I'll say if they can push below the mid band and the 1-to-1s, I don't want to be in it. I give it 8 ticks, maybe $100, right? I'll risk $100 to trade with a strong trending market. If they continue the strong trend, where are they likely to go? Fibonacci resistance is an amazing spot to look for. Little outside of the high probability trend trade because you're entering on the wrong side of triggers 99 out of 100 times with this particular trade. Another way to do it is if you don't want to just jump in and hope it doesn't go below the 1-to-1s, you can let it retrace and then you can enter on the way up and then use that bar that's going up for stop placement. So I'll let you guys decide. Which entry do you want to take? Do we want to just buy the mid band? Put a stop below the areas? You prefer the bar up, Jen? Well, too late now. Dagnabbit. 51.25. We'll give it to 49.25. And then Jen, if we get the up bar, that's your entry. Now it's starting to go up. You can see the buyers are trying to go with that strong trending market. If we get an up bar, guys, I'll go 2 ticks below it. And because I'm already on the wrong side of triggers, I'll probably go ahead now that they started up. If they get any lower than these 1-to-1s, it's probably not my trade. Because I'm already where the market shouldn't go. I'm counting on a strong trending market to give me a little love here. Some of you will say, you know what? With all the triggers above the fib, I'll put a little extra risk on it. Some of you will say in a strong trending market, the only thing that stops a strong trending market is a reversal bar on the large chart. I'll force them to take a reversal bar. It's totally up to you, guys. You'll create your own management plan, right? Watch this. If we get an up bar, we'll just add on to the position for Jen. So if this creates a reversal bar up, that's Jen's entry. The stop will go behind the reversal bar. If they don't, they're coming to get us. So we've got the buy the midband till it doesn't work. And then we've got Jen's entry at 63.50. And we'll see how it works out. Are there any questions about what we're looking at right now? Because it's strong trending, we assume momentum. Because all of the triggers are above trouble, we have a clear path. But we're entering on the wrong side of the market. The wrong side of the triggers. And we're hoping that the strong trend continues. That's all it is. It's hard to define a stop when you're already where the market shouldn't go in this trade. If you're not comfortable with that, it's okay to not take the trade. Strong trending markets don't happen that often, but when they do, that's the most likely spot for a bounce. Strong trending market is over on a reversal bar. Jen, you never got your up bar. Here's a white bar that should make an HVA line. So John used the HVA area before the confirmation. So John, zone reached, trouble reached, smalls below. There's the white bar confirmation. And then there is the HVA line. If it's confirmed, that's where it's going to print. So John went ahead and took his entry. You had the same thing, no up bar in a strong trending market. They still haven't made a reversal bar, right? There's your up bar, Jen. 2 ticks below it. Management looks a little weird now because we're in 4 contracts instead of 2. So what would take us out? A third divergence, right? A third divergence would be an exit condition, which means 1, 2 ticks below that reversal bar marker. And if they're going to continue the trend, guys, here we'll put our runner there. We'll put our first target at the $100, 51.75, 53.75. And if divergence prints, it's game over anyway. There it is, third divergence. Technically, you're supposed to exit. Change them 2 and 2. Well, I'm supposed to close my position. But if you wanted to do that, you could click here, make it a 2, and click yes, and then it'll change the 2 of them. If you were going to hold this position, you have to be below that reversal bar. And all you're doing is saying, because of this look, I'm anticipating more up. And until I get a reversal bar, that market's going to keep going. And guys, we're just talking through it here. 3 divergences is more than enough reason to exit the trade. But we're trading a strong trending market. And here we go. All right, let's see what you did, Victor. Bonehead trade. No, there are no bonehead trades, just great lessons, right? So, momentum, yes. Clear path, no triggers through problem area. None whatsoever. And the gap theory, did you see it? And you got seduced by the siren song of the small chart. The beautiful, melodious voice pulling Victor to the rocks, smashing his boat. No clear path. There's your gap theory. And you thought it was going to go, and it just didn't. Paid attention to the small chart for entry. Missed the plank on my eye. It happens, Victor. But the cool thing is, Victor, that because you did it, because you annotated it, because you presented it, what are you going to be thinking about next trend trades you take? Is there something in the way? Midband is still holding, guys. Midband is still holding. And that's it. You've got to look at everything. You've got to be in the moment. All right, there's your first target. Let's just go break even and let it play out. You want to see if it gets to the fib, guys? How about this? Do you guys remember yesterday when we said, as long as price doesn't get to the wrong side of these small triggers, it's still going up? Well, there we go. There's another divergence. It got us, but as long as it doesn't close on the other side of these triggers, it's probably still going up. There's your close below. And down it goes. Pretty neat, right? Cool little management thing there. Long as it doesn't get below them, or if it closes above them. And that was your 3 right in the same range, and that was your killer. It took 4 in the strong trending market. We made a few hundred though. Made a few hundred before it crashed. And the cool thing is that you saw it, Victor. But one of the great things that annotation does for you, and more importantly, annotation after the trade, when the adrenaline is gone, when the anxiety is over, when the trade is done, you can go back with zero fear and just read your indicators, right? And Victor, this is where I go hippie on you a little bit. I don't know if you have children. I would never call my kid a bonehead when he's learning something new. I would never tell my kid that he sucks. I would never tell my kid, what kind of stupid shit is that, right? Pardon my French. Guys, careful with the language you use around yourself, because you will convince yourself that you are a bonehead or that you're no good at this, right? You're just new. All right, the trade is bonehead, not you. I'll accept that. I will accept that. I'm trying to get Victor in a battle of wits and pull him down to my level and beat him with experience. But those are things that I think about. Language is important, guys, and you believe what your brain tells you. You believe what you hear. You believe what you say. And every trader makes bad trades. Only good traders rarely repeat them, right? How long does it take to become a good trader, John Novak? When can I expect to stop making the same mistakes over and over again? In a week? With a couple videos? Am I looking at maybe 30 days, 60 days, 90 days? I know how long it took me to get my English Lit degree. Learn the trades in 1 to 2 weeks. Learn you suck at trading week 3 through 52. Then realize you have to be consistent and make money forever. I'm glad that you followed up the second one. Guys, that's this right here. Welcome to every trader that you've ever met or will meet or is sitting in this room. It looks like fun. And then you realize that you're going to have to work. and then you decide not to do the work and get on simulator and make $1 million and go live. And I think when John Novak made this picture, he just didn't want to say the Mark Novak story, because this is when I went live. I lost $5,000 in 2 hours. I was so mad at you, John. Why did John give me this stupid software? And the one thing that I didn't do is exactly what John told me to do. Learn some simple rules, take a lot of pictures of them, and Mark, post them in the room so you can get feedback to make sure you're doing it right. And then you follow the plan, and off it goes. You needed to see that right now, Brian? This is literally my biography. Hey, Mark, what was it like when you got the software? It was this. I thought I was Billy Badass because my last name was Novak. I felt entitled to win without doing any of the work. And then I realized that I didn't know squat. I think SQUAT. Well, it doesn't fit, but I'm sure it's squat. And this is where I had to admit begrudgingly that my sibling was right. That trading without rules is foolhardy. Not having a plan is silly. Not knowing how you're going to manage a trade doesn't really work out. And short-term victories typically create long-term successes. But when you follow the path, every road bump, every pothole, every problem you could ever encounter, we have seen and we have worked through. And trading can be easy or it can be difficult. Amen. Morgan, what did you do? Morgan said on his chart, check it out, Mark. Odds favorable momentum, clear path, perfect entry, cost of doing business. I'd lose this one with you every time, Morgan. You had an edge, right? You had an advantage. You were able to recognize a trade that wins more than it loses. You were willing to take it, understanding that you're trading probabilities, not a guaranteed outcome. And nobody likes that outcome, but that's a part of trading. That's a normal part of trading. And John mentioned, it's the Mark Douglas things that you must get good at. Does everyone in the room know who Mark Douglas is? He's the late Mark Douglas, unfortunately. Absolute guru. I think I've seen everything that's ever been put out by him, and I still go back and watch him all the time. Hey, welcome, first day. Great to have you, THN. Thin6136, I'm not sure how to say that. We'll call you T. Welcome to the room. It's great to have you. The room is a discussion for sure. Ah, someone's being clever there. I like it. Who did that? Someone just wrote welcome underneath you. Morgan, nicely done. Guys, am I in the right frame of mind to trade, right? Gauge your state of mind. But when you stop expecting to win every trade, that's when you start winning most of your trades. When you focus on the execution rather than the result, you realize that trading is just probabilities, that you can define an edge, that you can embrace an edge, that you can find a pattern that wins more than it loses, and you can stick to it. And that's what's going to get you where you want to be. So they did decide to go back up, didn't they? Straight from support with every trigger above. I guess I should have just kept my stop at below the reversal bar marker. Sometimes you make some money, get out, break even, and that's just kind of what happens. That's the way it goes. Cookie crumbles, all that good stuff. Do you guys see it though? Resistance broke. Strong trending market. Resistance worked as support perfectly. Perfectly. And now where are they headed? I see a big red line. I would have rather they just kept me in and we went, but that's not always my choice. Not always my choice. All right, guys, I'm gonna stretch my legs. Go refill my water real quick. Pet my dog. Um, when I come back, let me know what you're thinking about. Let me know what you need help with. Let me know what's gonna make your life easier. Um, and we'll talk about it. So I'll be back in just a few minutes. Oh, let's finish strong today. I guess that strong trending market worked, didn't it? Look at that. THN 6136. I want to say welcome. Word on the street is that you are a TradingView user. I'm going to drop in the room for you right now a spreadsheet. It's a TradingView journal. And it shows the trades that we teach using the software, ideas on management. It's got a trade tracking sheet on it. Also, I'm going to drop into the room for you the actual plan that goes with it, and what this plan is going to do for you. I don't know how familiar you are with TradingView, but in the plan, it tells you the 2 time frames in the workspaces, tells you what they're going to be used for, where entries come from, and then checklists for entries. And then the idea is that we're going to keep repeating every day the basic concepts, every day what it takes to find an entry, every day when it's time to pump the brakes and maybe not take the trade. And through that repetition, the goal is to get the recognition. So on TradingView, guys, here we go. Strong triggers up, smalls above the large, space between. We are on the strong side of small triggers. My job is to look for a trade to go long with the trend, with the momentum. A great way to do that is using these zones. And that zone is a great spot for a bounce, close above the triggers, maybe look for continuation. The only challenge is we do have little one-to-ones that are creating problems for us right now in the moment. S&P is the exact same look as the S&P is. That HVA, it's your line in the sand, right? Everything says up, smalls above the large, pulls back to the HVA, and sure enough, off it goes. Crude oil, strong triggers down, nowhere to go. Directly into an area, absolutely nowhere to go. And if you look at crude oil, absolutely nowhere to go. These two will line up sometimes, they won't always. But we know where trouble is. We can identify where trouble is. And we can choose not to trade into it. Guys, what do you want to talk about? Got no rules met for a short trade. I have to sit on my hands for a minute. Have to pause. Have to be calm. Because horizontal lines on a large chart can stop forward progress. And forward progress is how we're going to make our money. All right, Paul W., sorry I missed your picture. Guys, do me a favor. If I ever miss a picture, Paul, we're going this way now. I'm assuming we're talking about this trade. I don't know which direction you're going, though, so let's take a look. Large chart says down. You're in at 66 flat. So you are on the weak side of down triggers and a downtrend. And then, Paul, do you see that white line? Say hello to the VWAP, my friend. The volume weighted average price, mess up your good time line. And it looks like from 660... Did you go long or short? 15 minutes strong down. VWAP is, okay, as resistance. 1 minute VWAP, 1-to-ones. 1 minute zone is resistance. Entry below the large triggers. Profit at 0.75. Pulled stop to 1 tick above. Stopped out. Price went to target area. So, Paul, your trade would have been an HVA trade. But what you did is I guess you just went short directly into the support, which is okay. It could create a bounce. But if you're trading from the zone, with the direction, everything down, Paul, a tick is a rough is a rough stop. One tick above, what's WBP? White bar. Okay, so you went a tick above this white bar, but you didn't have your HVA yet, and I think that's what it was. This zone is your line in the sand because it's technically not an HVA trade, Paul. What you're doing is you're selling this zone, hoping everything goes down. So the stop logic is if I'm selling below this zone, hoping the zone holds, my stop belongs above that zone. Does that make sense, Paul? Because it's not really an HVA trade. That's your line in the sand. That's your man. They're going to have to get up here before I exit all these great conditions. And they tried. They came and retested it beautifully, and it's just too tight of a stop. Now the next question is, once you got stopped out with all the triggers down, you could have gotten back in. Oops, my stop is wrong. Let me get back into the right trade, right? Let me get my stop where it doesn't go. And that's probably going to be one of the progressions that comes in time. Good stuff. Great large chart read. Great thought process. Just a little challenge on the stop. All right, missed midband is possible divergence. So divergence is a loss of momentum. Andy, just for language, midband termination condition because the large triggers were a full bar away. But let's look at this. When you entered, 4 triggers were through. So let me look at your prices. You were in at 70, which would have been, and you're missing your synthetics. I see what you're talking about. Managed a $10 loss, had my target one bid at the mid-band, would have been profit. So you're missing your synthetics. Andy, do you see it? So you took your entry and your synthetics would have been right about here, which means you probably would have stayed into that trade. It didn't go where the market shouldn't. You can see how it never gets outside of those synthetics. And then it continues back up. And it was just that mid-band that got you. So trading to the mid-band, I'm assuming it's hard to gauge your entry. Did you really jump in right here with the momentum? Or did you get in at the mid-band? Okay, so I wanted to make sure. Was it your charts where the entries were weird looking? So we've got those fixed now. All right, so let me change my thought process on this because I thought you took a trend trade. So with momentum, nothing in the way. With momentum, nothing in the way. In at 70. And then you're absolutely right. Your target is the mid-band, because the large triggers are a full bar away, and you can avoid all of that. So getting out with a $10 loss is pretty outstanding. Look at my entry, more like blue box. Did you actually get in on that bar? That's a big box. Did you enter here? Let's play the did you do it here game. Did you enter right here? Did you enter right here? Did you enter over here? Maybe we are still messed up. And I apologize, Andy. I know that it's probably frustrating when you know exactly what it was and I'm trying to catch up with you. When you entered, there were 4 triggers through. So was it this entry right here? There we go. That was it, because there's your line. So that was probably it right here at 70. The blue box, was it this part of the blue box? Was it this part of the blue box? Or was it this part of the blue box? Was it everything down? Was it only small? Okay, so you had odds favorable. We're going to get there. You had odds favorable momentum. Did not have a clear path. You took the entry at the mid-band, right at 70. Stop didn't go below the synthetics, which are missing. And the market did continue up. Andy, I'm so sorry. Are we talking about... Can't be that one up there. Managed a $10 loss. Had my target one been the mid-band. Would have been profit. And I know this is frustrating for you, and I don't mean for it to be. When you entered, there were 4 triggers through. This does not look like my entry view. Up here, can you do this for me, Andy? And I know that this is... Take the exact same picture and use your shape and just give me a box where you entered. Was it that entry? If you just give me a box with an arrow, I got in here, and maybe give me a down arrow with a little box, I got out here. And then that way we can still do the read. But one thing is you are missing your synthetics over here. So if you want to right click on your small chart, Andy, and go to templates and reload that 5-1 Renko bar chart, get those synthetics on there. It'll help with stop placement. But if you'll put those boxes for where you entered and exited, that'll help me a lot since your markers are a little sideways. There's that pullback to the HVA. We've seen this one once or twice. There's that market rocketing off of the HVA. There is taking profits and adding on right at an HVA. Absolutely nothing to lose. Fresh bar up, closing above, 31 ticks in the bank. Nicely done. No worries. Are you ready, Andy? Nice job, John. So on your small chart, if you right click and go down here to templates and then load, we're going to look at 5-1 Renko bar chart. And what that's going to do is that's going to be the one that gives you those synthetics. And then just hit load and it'll go through and it'll put everything that belongs on that chart on the chart. Because I noticed that on yours that your synthetics aren't there. And those synthetics are huge for risk management and for accuracy, I think. And it looks like, depending on where you entered, it never really gets below those synthetics on either of them, which keeps you in the trade. Still haven't broken the termination condition here. Not yet. John Novak, solid trading. Not with market flow, Andy. So when you go to the templates, it is just going to say 5-1 Renko bar chart. That's it. I like it. John's like, oh, that wasn't John. That was the bot. You can use market flow for entry, but that's not what we're talking about. So it is that bad boy right there in between or just below the market flow overlay. Drop that in the room. And that'll get you those synthetics. Hey, K Price. Oh, yeah. HVA trade. Pulls back to the HVA. K Price taking a page out of John's book, but doing it on the S&P. Gets above trouble, pulls back to the HVA. Your entry is right there at the high volume area line, and it just never even blinked. I sure hope they're able to break through the zones and the outer bands for you for that profit target. But if they don't, 625 locked in. What a hell of a trade, K Price. And look at K Price's trade. And look at John Novak's trade. It's the same trade. Just different markets. Nicely done, K Price. It worked for you, Andy? Awesome. Termination held it, didn't it? Termination held it. Are you blowing me kisses, Victor? It's getting weird in here, man. Momentum, yes. Oh, that's a whistle. Whew. No clear path. 2 triggers through the blue fib. Barely 1 trigger through divergence. No clear path. No need to find entry yet. Waiting. Nicely done, Victor. I told you. Guys, when you make mistakes, you will learn from those mistakes. When you go back and talk about what went wrong on your trade, you are less likely to repeat what went wrong. Check it out. The trade was bonehead, not Victor. Clear path, not at all. No triggers through. Problem area. I got sucked in by the small chart. And Victor says, not this time, small chart. Not going to do it to me. I've been hurt before. Great job, Victor. Guys, John Novak said it earlier. Good traders don't repeat the same mistakes. And the only way to learn from the mistakes is you got to make them first. But then you have to accept them. Hey, I made a mistake. Maybe I'm not the best trader in the world yet. Maybe I do need to study a little more. Maybe I do need to take more pictures. Maybe I do need to annotate charts. But guys, if I can learn to read these charts, any of you can learn to read these charts. I'm as right-brained, artsy-fartsy as they come. It's just patterns. Great job, Victor. Feeling pretty good about not taking that entry right now, aren't you? You're like, wow, that was money I didn't have to lose. 2 triggers through. Not my best look. 2 triggers through. Not my best look. Have we mentioned that? 3 triggers through. You guys are finding a lot more success with 3 triggers through. Crude oil, zone holds. No HVA trade lined up. But with strong triggers on the other side and room to trouble, you could have bought a pullback. Did they make it? Oh, that outer band. Did they make it? Oh, that outer band. Guys, outer bands are great targets on TradingView, especially when there's a zone next to them. They made it to 69.50. They overran a little bit, just above. This is one of those times where if I'm hoping it continues up, once I break above the zone, right behind the zone. And I think that's what K-Price did perfectly. Right behind the zone. If it's really going to break up, it's going to get above, right? And if it's not, if it's going to come down, I'm not giving it all back. Great management. You can hold for bigger moves, but you don't have to give it all away if it doesn't work. Sorry, I had to consult my marketing lady on something real quick. Did you hold that one, K Price? That's a big retracement. I love getting paid. I'm such a big fan of getting paid. Then with everything up and strong triggers, there's your close above for continuation if you were going to do it. Got out at 700. Great trade. 70. I mean, great trade. $700. It's hard to go wrong with a $700 trade. Did you guys know that it's not the $700 that makes the day? I'm going to tell you right now. It's not the $700 that creates awesome, awesome traders and makes life good. That $700 is impactful if you don't lose $1,000 breaking your rules. Anyone ever had a day where you had 3 perfect rules met trade? You made $750, $800, $900 on those 3 trades, but your opinions put you in the negative for the day? I find the difference between successful traders and the traders that are struggling just a little bit are the people that give money away when there's really no reason to. And it takes some study and it takes some trust to be able to sit still in a market that's moving, because every tick is worth $12.50, right? Every tick is worth $10. Every tick is $5. That area lost you 300 at first because you didn't follow the rules. But what a great lesson, K Price. I'm telling you guys, you have got to break rules to be focused on following them. You've got to make mistakes to learn how to avoid them. And for every loss that you take when the rules aren't met, Exhibit A, for every loss that you take when the rules aren't met, you're less inclined to take that loss. You're more focused on following a plan. Guys, we've made it as easy as we could possibly make it for you by handing you the plans. Classes